Not that long ago, if you wanted to analyze millions of data points in under a millisecond, you needed a Wall Street budget. That kind of raw computing power was locked up in expansive data centers, exclusively available to the world's largest hedge funds. Today, that exact same analytical horsepower is sitting inside free apps on your phone. Everyday traders now have access to tools that would have cost millions of dollars to develop just a decade ago. But access has brought a relentless surge of hype. Open any social media feed, and you'll find influencers promising that their new AI trading bot is a literal crystal ball. They're selling the idea of guaranteed daily returns and zero-effort wealth. The reality is much less glamorous. These artificial intelligence tools are highly capable at specific tasks, but they cannot eliminate risk from the financial markets. So how do you actually use this technology to get a genuine advantage without falling into the traps that wipe out inexperienced traders? The safest and most practical way to start using AI is to treat it as a research co-pilot. Instead of spending hours reading through a dense 40-page earnings report, you can feed those documents into a large language model like ChatGPT or Claude. The AI can instantly translate technical financial jargon and pull out the most important highlights, accelerating the early stages of your research. The next step up is using AI as an analyst to read hard data. This animated chart shows technical pattern recognition. The software traces the peaks and valleys of price movements, looking for geometric patterns that signal a price change. While humans take days, AI scans thousands of stocks simultaneously, dropping markers on matching charts in seconds. Beyond price charts, AI models also process the soft data of human emotion through sentiment analysis. This gauge represents a sentiment meter. By scraping millions of news articles and social media posts, the AI processes all those headlines pouring in and calculates a real-time score of how the public is feeling about a specific asset. At this stage, the software is doing the grueling work of a dozen analysts. It compresses thousands of data points into a manageable watch list. But crucially, it is only giving you information. It is not making the final choice to buy or sell. The top of the automation ladder is where the danger sharply increases: algorithmic trading bots. These are automated systems that react to live market data and execute trades based on a set of predefined rules. They buy and sell in mere milliseconds, removing the need for a human to manually click a button. Institutional trading firms have used variations of these bots for decades. The difference is that Wall Street firms have entire teams dedicated to building institutional-grade safety protocols to stop a bot from making a catastrophic error. The consumer versions available on mobile apps usually lack those safety nets. When you hand over full autonomy to a piece of software, you introduce a new magnitude of financial danger to your portfolio. The moment you cross the line from using AI for research to letting it autonomously execute your trades, you risk turning a valuable analytical tool into a significant financial liability. There is a severe limitation built into all AI trading tools. They are trained exclusively on historical data. They only know what has already happened. This chart illustrates overfitting, when a model memorizes historical patterns instead of learning general rules. It looks impressive in testing, but crossing into live data, the market moves erratically. The overfitted prediction line shoots off in the wrong direction. It hasn't memorized this future. Historical patterns constantly break down in the real world. Sudden geopolitical conflicts, natural disasters, and sheer human panic create chaotic variables that simply do not exist in the training data. Because financial markets are driven by unpredictable human emotion, a machine that only knows the past cannot be trusted to guarantee the future. This is why you have to be deeply skeptical of the aggressive marketing targeted at retail investors right now. Any product promising high win rates with minimal risk is selling a fantasy. The practical approach is to treat AI as a high-powered screener. Let it quickly filter down thousands of potential trades into a small, manageable list, rather than relying on it as an autonomous decision-maker. If you do decide to experiment with automated trading bots, do it strictly as an experiment. Only use a small amount of capital that you can genuinely afford to lose completely. The final trigger to buy or sell should always come down to your own judgment, your own strategy, and your personal understanding of the downside. Artificial intelligence gives retail traders substantial gains in research speed and pattern recognition, but it is still just a tool. There is no technological shortcut to removing risk from an inherently risky market, and the ultimate responsibility for your money still rests entirely with you.